Welcome to the deep dive. Today we're doing something really special, I think.
Yeah.
We're going to unpack decades of wisdom from the Berkshire Hathaway annual meetings, specifically Warren Buffett and Charlie Munger.
Ah, the legends themselves.
Exactly. But forget the complex Wall Street jargon. This is all about their fundamental truths, often surprisingly simple stuff on business, investing, smart decisions.
Straight from the horse's mouth, so to speak. It's distilled wisdom.
That's it. Think of this as a deep dive into their thinking.
Right. And those Q&A sessions, they're unscripted. That's where the real gold is, I think, for over 30 years.
An unparalleled learning opportunity, really.
Definitely. So our mission, if you like, is to extract those actionable lessons, the aha moments.
Give people a shortcut to their core principle.
Exactly. Show that long-term success isn't about, chasing fads. It's about clear, fundamental thinking.
And all this comes directly from those meetings, right?
Yeah.
Decades of Q&A.
That's the source material, a real treasure trove.
Okay, let's dive in then. Where should we start? Maybe understanding the actual businesses.
That's the cornerstone. Buffett's been saying it forever. Successful investing comes from understanding businesses, not just the stock market.
Okay. Is there a classic example of that?
Oh, absolutely. See's Candies. They bought it way back in 1972. A perfect illustration.
See's Candies, right? What was the insight there?
Well, it wasn't some complicated spreadsheet model. It was a really simple, powerful question Buffett asked.
Which was?
He basically said, look, if someone had, say, $100 million, could they come into California and successfully challenge See's, build a real competitor?
And the answer was clearly no.
Pretty much immediately no. And that simple thought experiment revealed this incredibly strong competitive advantage, a moat, as he calls it.
A moat that's lasted decades.
And generated what, over $2 billion in profits for Berkshire since then? It just shows understanding that enduring advantage was key, not market timing.
It's about the business, not the stock price flicking around.
Precisely, which leads nicely into their idea of the circle of competence.
Right. I love this concept. It feels freeing in a way.
It really is. You don't need to be an expert on everything. That's impossible.
Just focus on what you can understand well.
Exactly. Stick within your circle. Buffett uses that baseball analogy a lot.
The batter waiting for the right pitch.
Yeah. You don't swing at everything. You wait for the pitch in your sweet spot, where you know you can make good contact. Investing's the same.
So find industries or companies you genuinely get.
And really dig into those, like Buffett did with Geico way back in 1951. He saw a simple, powerful insurance model he could understand deeply.
Within his circle.
Within his circle. And that deep understanding gives you conviction.
Which connects to the time horizon idea, doesn't it? You
Yeah.
need conviction to hold long term.
Absolutely. This is crucial. Buffett's famous line about the market being a voting machine short term.
But a weighing machine long term.
Right.
Right. Based on emotion versus actual value.
Exactly. Short term, it's popularity contest. Long term, the fundamentals, the actual weight of the business. That's what matters.
Can we see that play out in one of their big investments?
Well, Coca-Cola is a great example. They started buying heavily in 1988.
Okay.
At the time, the price, maybe $11 a share. Some people thought it was expensive. Market sentiment wasn't universally bullish.
But Buffett saw something else.
He saw the enduring brand, the global growth potential. He was looking decades ahead, not just at the next quarter's earnings.
Playing the long game. The weighing machine.
Totally. And look what happened. By 2023, those shares had multiplied, over 20 times? That's the power of that long-term view on a quality business.
It really forces you to shift your mindset. Think like you own the whole company, not just a stock certificate.
That's the core shift. You're buying a piece of an actual business, a real enterprise with real economics.
Your focus naturally goes to its health, its prospects.
Right. Not the squiggles on a chart. Buffett and Munger spend their time reading annual reports, understanding business models.
Not staring at stock tickers all day.
They're looking at the underlying value drivers. Things like, pricing power, competitive position, management quality, not just PE ratios, which can be, misleading.
So the big takeaway from this first part seems to be, it's about discipline, applying these core ideas consistently.
Yes. It's not about being a genius. It's about having the right framework and the discipline to stick to it.
Okay. So once you understand the business, the next step has to be valuation, right? Figure out what it's worth.
Exactly. That's the next critical piece. And again, you might expect complexity here.
But knowing them, probably not.
Right. Their approach is surprisingly straightforward. Basically, if you need a super complex calculator or spreadsheet,
They're probably overcomplicating it.
that's the gist. It's more about simple estimates of future cash flows. What cash can this business generate over time?
And then being patient enough to buy it at the right price, a price that makes sense.
With a buffer. Which brings us to intrinsic value. They often use that old Aesop fable.
A bird in the hand is worth two in the bush.
Right. But Buffett adds a crucial twist.
Which is?
You also have to ask, when do you get the birds in the bush? And what are interest rates doing? It brings in time and opportunity cost.
Okay. That makes it much more practical for investing.
It does. Think about See's candies again. Maybe traditional metrics didn't scream cheap.
But they saw the predictable cash flows.
Exactly. Reliable cash, year after year. That was the bird in the hand, in a way. Or maybe a very reliable bird arriving from the bush soon.
And because Seas didn't need huge reinvestment.
Right. It didn't need all that cash itself. It became this generator throwing off cash Berkshire could use elsewhere.
So value isn't just about growth, it's about predictable profitability too.
Absolutely. And this is where they look beyond just the numbers. Many people get fixated on PE or book value.
But Buffett and Munger care more about the qualitative stuff.
A huge amount more. Competitive advantages, brand strength, and crucially, management quality and integrity.
They always say they'd rather buy a wonderful business at a fair price.
Then a fair business at a wonderful price. That sums it up perfectly. Quality comes first.
Which ties directly into the margin safety idea.
Yeah.
Ben Graham's concept.
Absolutely core to their philosophy. Build in a buffer. Don't pay exactly what you think something is worth.
Leave room for error or unexpected problems.
Precisely. Buffett's bridge analogy is great here.
The one about weight capacity.
Yeah. If a bridge holds 10,000 pounds, you don't drive a 9,800-pound truck over it. You drive something much lighter, like 4,000 pounds.
That gap is your margin of safety. Give you confidence.
And protects you if your estimate was a bit off or if things go wrong. It proved invaluable in downturns like 73, 74.
When everyone else was panicking.
They were buying
Yeah.
because they understood the value of great companies and the prices were way below that value, offering a huge margin of safety.
So for valuation, the lesson is be approximately right, not precisely wrong,
Yeah.
based on understanding the business.
That's it. You didn't need a PhD to value C's. You needed to understand its enduring appeal and pricing power.
Okay, so understand the business. Value it sensibly with a margin of safety. What's next? Putting the money to work.
Capital deployment. The art of investing wisely once you found those opportunities.
And Berkshire has a clear approach here too, I assume.
Very deliberate. It really boils down to three things. Understanding opportunity cost, having clear investment criteria, and always focusing on preserving capital.
Opportunity cost.
Yeah.
That seems fundamental.
Right.
Every dollar you invest here can't be invested somewhere else.
Exactly. It's not just, is this a good investment? It's, is this the best use of this capital compared to all other possibilities right now?
That's a high bar.
It is. It forces discipline. Think about 2008, the financial crisis.
Their investments in Goldman Sachs, GE.
Those weren't just random bets. They judged those at that specific moment as the best risk-adjusted places to deploy billions, given the alternatives. That's opportunity cost thinking in action.
And their discipline shows up in things like stock buybacks too, right?
Yeah.
Just buy back shares whenever.
No. Unlike many companies, they have strict criteria. They only buy back Berkshire stock if they believe it's trading meaningfully below its intrinsic value.
They even set a specific rule at one point.
Yeah, back in 2012, they said they'd buy below 120% of book value. The point is, the buyback has to create value for the remaining shareholders, not just prop up the price. Seems obvious, but
Often ignored.
sadly, yes.
And what about when they buy whole companies? Acquisitions. Capital preservation seems key there.
Absolutely paramount. They're not looking for quick flips or financial engineering. They want great businesses they can own, ideally forever.
Quality over cleverness.
Definitely. Quality of the business, quality of the management. Think See's candies again.
They kept the management, let them run it.
Exactly. No big shakeups. That respect for the existing business and people is why family-owned businesses often want to sell to Berkshire. They know the legacy will be preserved.
That ties into the capital preservation idea. Don't mess up a good thing.
Right. And that long-term view pays off in other ways, too. Look at National Indemnity, their insurance company.
The one they bought back in '67?
Yeah. There were times the insurance market got hyper-competitive, really tough pricing.
So, National Indemnity.
They actually cut their business volume dramatically. by like 80% sometimes.
Wow. Most companies would chase revenue, even bad revenue.
But Berkshire prioritized underwriting discipline over volume. They preserved capital by refusing to write business at stupid prices.
And then capitalize when things improved.
Precisely. That patience, waiting for the right pitch again, led to much better long-term returns. Discipline in capital deployment.
Okay, this all makes logical sense, understanding, valuation, deployment. But
Yeah.
it all needs people to execute it, right? Management, culture.
You've hit on the next crucial layer. You can have the best strategy in the world, but without the right people and the right environment, it falls apart.
So how do Buffett and Munger approach that? It seems different from standard corporate America.
Very different. It's deeply rooted in understanding human nature, motivation, and trust.
And character is huge for them. Buffett's 3 I's.
Intelligence, initiative, or drive, and integrity. And he always stresses that without integrity, the first two can actually destroy you.
Integrity is the non-negotiable.
Absolutely. The Salomon Brothers crisis in the early 90s really hammered that home for him.
When one trader's actions threaten the whole firm.
Exactly. It showed how quickly reputation, built over decades, could be destroyed by a lack of integrity. His response was all about protecting that reputation above all else. Money can be regained, reputation, not so easily.
And does this focus on integrity influence how they structure things, like pay?
Definitely. You don't see the typical complex stock option plans everywhere at Berkshire subsidiaries.
Well, why not?
They prefer simpler compensation tied directly to what managers can actually control and influence in their specific business.
Like at Jokeko.
Right. Bonuses might be linked to policy growth and profitability of existing business things the Jayako managers directly impact. It avoids rewarding people just because the overall stock market went up. Munger especially dislikes complex pay schemes that, incentivize the wrong things.
Makes sense. And the culture itself is famously decentralized, isn't it? Tiny headquarters for such a massive company.
It's incredible. Buffett calls it delegation bordering on abdication. They push responsibility way down.
And that attracts a certain kind of manager.
It attracts leaders who are independent, who think like owners, who value autonomy. They don't want layers of bureaucracy. Think of Rose Blumkin at Nebraska Furniture Mart.
Mrs. B. She kept running Array after Berkshire bought it.
Exactly as she always had. That trust and autonomy is central to the Berkshire culture.
How do they handle problems then with so much decentralization?
Swiftly but thoughtfully. Buffett's guiding principle after Salomon is a good indicator. Think how your actions would play in tomorrow's paper.
A simple ethics test. Reputation again.
Right. It's often more effective than a huge rule book. And because Berkshire is so financially strong, managers aren't pressured into short-term fixes that might compromise ethics. They can afford to do the right thing.
It sounds like they've built a culture designed to last, even beyond Buffett and Munger. Succession seems baked in.
That's clearly the intent. Attract managers who want to build something enduring, who know their work won't be undone by the next corporate fad. That promise of permanence is a huge draw for talent focused on the long term.
It's a very human-centered approach, really.
Yeah.
Trust, autonomy, integrity.
Which brings us to maybe the engine that powers so much of this. The insurance businesses. You can't really understand Berkshire without understanding insurance.
Right, the float. That's the key concept here.
Absolutely central. Starting with National Indemnity in '67, they've built this world-class insurance operation, and that generates float.
Which is the premiums collected before claims are paid out, money they hold.
Exactly. And Berkshire currently holds something like $165 billion of it, give or take.
That's a staggering amount of money they get to invest for their own benefit.
It is. But what's unique about Berkshire isn't just the amount, it's the nature of their float, because of their huge capital base.
They can treat it almost like permanent capital, like equity.
Pretty much, it's incredibly stable, it's not going to vanish overnight, it's like having a giant zero-cost long-term loan.
Which gives them enormous firepower for investments and acquisitions.
Unmatched firepower. It allows them to take on huge, complex deals others can't touch. Remember when AIG needed to offload massive long-term liabilities?
Berkshire stepped in because they had the capital and the long-term view.
Exactly, or providing support to Lloyd's of London during tough times. Being the strongest player financially creates unique opportunities. It's a virtuous cycle.
But again, it's not just the money, it's the discipline, the underwriting quality.
Crucial. That National Indemnity example of slashing business volume rather than writing bad policies, that's the bedrock.
Prioritizing profit over premiums.
Always. Long-term profitability over short-term growth. It's rare, especially in publicly traded insurers facing quarterly pressures.
And Ajit Jain's role here. He built a huge reinsurance operation from scratch.
An incredible story. No prior insurance experience, yet he built this innovative, highly profitable reinsurance powerhouse within Berkshire.
Combining disciplined risk-taking with Berkshire's capital strength.
That's the magic combination. His talent combined with the structural advantages of Berkshire, it allows them to take on risks others can't, intelligently.
And even when there are bumps, like with Gen in Chile.
Their long-term structure allows for patience. They took years to carefully fix the underwriting issues at Gen rather than panicking.
Methodical improvement.
Exactly. So that combination, permanent capital from float, iron discipline in underwriting, and exceptional leadership like Ajit Jain, it makes the insurance operation a massive, durable, competitive advantage. It fuels the whole enterprise.
So wrapping this all up, if you had to distill the core message from all these decades of Buffett and Munger wisdom, what would it be?
I think it's that building real, lasting wealth isn't some mystery. It's a process, a systematic one.
Based on?
Based on really understanding businesses, being disciplined about valuation, being smart and patient with capital, and crucially, fostering a culture of integrity and strong management.
It comes back to those key principles.
Yeah.
The owner's mindset.
Practical valuation, disciplined capital use.
And recognizing the unique power of that insurance float for Berkshire.
Absolutely. It all interconnects.
Okay, so a final thought for our listeners to maybe chew on.
Yeah, maybe think about this. How could adopting that long-term business owner perspective change your approach? Not just to stocks, maybe, but other areas.
Like what?
Well, think about your career or maybe a side project or even how you run your household finances. What are the fundamentals there? What's the real value? Where should you allocate your resources, your time, your money, your energy for the best long-term outcome? How can focusing on quality and integrity apply?
Thinking about the businesses in our own lives through that lens.
Yeah.
Interesting.
It's just a thought. Applying those fundamental principles more broadly could be powerful.